Morning, everybody, and thank you for coming along and listening to our presentation. I'm John Arnold, Circle Property Chief Executive, and Edward Olins, my Chief Operating Officer. We've been running Circle for many years. I started in 2002 and have been building up the business ever since. Circle Property is a specialist regional office investment and a development company operating throughout the UK. We have a £124 million worth of property currently in the portfolio, comprising 16 assets, 21 buildings, primarily offices, with the exception of one, which is an industrial building. We have seen a 22.6% increase in the portfolio value in the first 6 months, and we've just announced today a total return of over 20% for the year. We are able to achieve so far 32% compound average growth rate and are in the fortunate position of having a 21% under-rented portfolio. So that means if we get a vacancy, unlike if we own a shop or a retail warehouse where we'd be struggling to maintain income if a tenant leaves or doesn't renew their lease, we're confident that we can re-let at a higher rent. So that's a good position to be in. Generally, we're rubbing our hands together if we find we have a vacancy because we think we will do better. Our performance targets are to achieve 12% minimum geared target returns on acquisitions and 20% a minimum target return on cost of development. That includes the acquisition of the property and all costs. We'd like to be able to achieve a 20% return on that. We're currently giving a dividend yield of just over 3%, but we have a progressive dividend policy, so we anticipate that that return will grow as our profitability increases and the operating profits rise. We will be following in their footsteps. Over the last 2 years, Circle has been the best performing UK real estate company in the UK listed property sector, that is as measured by total net asset growth.
So what we do, we add value to underutilised regional offices. So what we have here is a building, one of the case studies we acquired in Birmingham, and it was a long lease, let to a firm of solicitors who vacated, and we acquired the building just as they were about to leave, refurbished it and put new life back into the building and then relet it and creating its value. So to the crux of it, we source deals with added value potential in the regions. And what we don't do is we don't buy buildings that are in secondary or over-rented assets. So that's, as John was saying earlier, we're after the increase in the rents once we've done a refurbishment, not actually having the rent drop on us. We don't wait for yield compression. So we do get yield compression from this deal, but that's happened because we've actually created an investment and the yield went down. We just don't wait there and hopefully the market will show yield compression. And we just don't bulk up the portfolio with income and put debt against it and then just say, look, here's the return we're going to do. We're one of the highest yieldings. We're a total return player. And what we also don't do is we don't buy in weak or non-institutional locations. So effectively we buy from the funds, the end-of-life buildings that we reposition, let and move on. The portfolio is just under £125 million. 77% of it is located in Milton Keynes, Birmingham, Bristol. So Milton Keynes, second fastest growing city behind Cambridge. Birmingham, the city number 2, and Bristol's done very well as well, moving forward with the high tech side. And also it's been hit by permitted development rights, which we'll come on to shortly. Portfolio value by sector, we're effectively all in the regional office sector. We did have some legacy buildings, some retail and some retail warehouse, but those are subsequently sold and we're refocusing the proceeds of that back into regional offices.
Yes, all of those retail properties have been sold in the current last financial year ending March 19. £9.4 million worth of disposal. So now we're down to almost entirely offices with one industrial. The board comprises Ian Henderson, our chairman, former CEO of Land Securities. I've been involved in properties all my working life. I've been at Circle since 2002, originally as a limited partnership, then as a unit trust, and more recently for the last 3 years as a AIM-listed PLC. Prior to that, I was working for what was Berkeley Hambro Property Company, running their property division until it was bought by Investec.
I joined in 2006. My background is I did investment agency from 95 to 2003 in the West End, and then went client side and joined John 2006 to help move Circle forward.
Ian, myself and Edward are all chartered surveyors, and we are committed to hands-on approach. We're not just collecting rents. We all take a very detailed and analytical approach to property. Jamie Hambro is also on our board as a non-exec director. He and I started this business in 2002. He's also got considerable property expertise, having formerly been on the board of Hanstein and NED of Primary Health Properties. Michael Farrow and Damien Jepson are the two Jersey directors. We are a Jersey-based business, and the Duke of Roxburgh is a large investor. Between us all, we own a third of the business, so our interests are very well aligned with the shareholders at large. The history, as I've suggested, it started in actually before this graph, 2002, as a kind of investor club. Myself and Jamie Hambro, with a number of our friends and contacts, collected £7.5 million, and I was told to spend it wisely. By 2006, that had grown to 15 million, so our 50p had turned into £1. Edward joined at that point, charged with helping us to spend another 11 million at that point that we raised. But it soon became fairly clear that the market was overheated and it was a seller's market rather than a buyer's market. As we all know, it's very easy to raise money at the top of the market, but the last thing you should be doing at the top of the market is spending it. So although many of our peers were rushing to get invested and probably get their management fees up, we took a contrary approach and were selling a lot of stock, reducing our debt, and battening, frankly, the hatches down, because when the market went down 40%, so did we, but because we'd repaid our debt, we didn't go bust. We were never in breach of any of our banking covenants, although we were capable of borrowing up to 75% loan to value at that point. We'd reduced considerably and lived as a result to tell the tale. And then it's been a fairly consistent rise since those difficult days of 2008-9 with the subprime crisis causing the problem, and we all know the rest. But since 2016, we've been paying a dividend, 2.4p, rising to 2.6p per half year. We make 2 dividend payments a year, at the full year and at the interim stage. Currently 3p per half year per share, and that equates to around 3% at the current share price. But as our operating profits increase, so will the dividend. We're always covering the dividend out of operating profit. We're not paying shareholders out of added values, and we're only paying it out of cash receipts.
The strategy, well, it's adding value to underutilised regional offices. And what we do, we buy regional offices that are too small for the typical institutions. So they're at £20 million plus, and they're too large for the private investors who are £3-4 million. They're needing capital expenditure on top. And where there's an existing vacancy or very short-term income, so it's a turn-off for the REITs. So our lot size is around £6 to £12 million per asset, plus capital expenditure on top for the refurbishment. So we're buying buildings let on short leases that are vacant, buildings needing refurbishment, with a scope for rental growth because we are refurbishing the building, putting it back into the market and capturing the new rent. We buy off low capital values, which enables us to do the refurbishment and then to hopefully stay on a yield on cost, depending where we are, between 7 and 9%. And then we're all in very strong city centre locations and established out-of-town locations. We're in the cities that have catered for the SME markets. So there's the small and medium-sized companies, the accountants, the solicitors, the recruitment consultants. If they're there, well, that's where we are. And 70% of all lettings in the regions are in the 1 to 4,000 square foot range. That's the churn, and that's the size of the offices these guys take up. And that's also been affected by permitted development rights. So permitted development rights, which John will come on to in a moment, is where the government let you change offices to residential without the use for planning permission. So what's happened here is the supply of the old second-hand grade B stock, the old £10, £12 a square foot stock, has disappeared. It's gone over to residential, and no one's really building new. So good quality refurbished grade B product has moved forward in rents. So the demand and the supply has changed in our areas.
This illustrates the point that Ed has just made. With all this change allowed by the government of office buildings converting to residential, we've seen it more recently on the news, it's become quite topical. We're happy for this process to continue. It's been going on for a number of years, and it's resulted in the supply significantly reducing. Over the 5 years from 2012 to 2017, the office availability in these towns or cities has shrunk by the amounts we're showing there. 60% in Birmingham, 16% in Bristol, 50% Northampton, and 35% in Milton Keynes. That's not entirely attributable to this change from office to residential. It's also due to the fact that new office stock is not being built. Or if it is, it's being built because it's pre-let to major occupiers, usually at fancy rents, because you need a big rent to justify knocking down a building and putting up a new one, or building on a greenfield site. We're not in that business. We are in refurbishment of tired stock that needs some TLC. And that means that rents have been growing significantly.
Operational highlights for the half year up until September 18. We've just had our year end, actually, March 31. It shows what we've been up to over the period. And we've been busy doing lettings, increasing our rental income and selling off non-core high street assets, well, the retail assets. The rental income, we increased it to 7.5 million from 6.8 million. And we have a reversion of just under 10 million. What the reversion is that once we're fully let, the income we will capture when all the buildings are occupied. And we've done some substantial lettings and lease re-gears. Some of those are the case studies which we'll come on to. And then our financial performance, well, the growth in NAV, you can see it year on year from 17 to 18, which is almost 20% and 26%. And then the year end from March on the pre-tax profit, 9 million, 14 million. And we've just released an RNS today, which is another 20% increase on returns. The investment opportunity, so the net initial yield is 5.6% with a reversion of just over 7.3. So that's once we've captured the increase in rents at closer to the 10 million. And we have a low capital value in the portfolio of £192 per square foot. And our rents are low, of £14.80 overall. So in Birmingham, we've just done lettings at £20.50p. In Milton Keynes, we've just done 20,000 square foot, £17.50. In Staines, we're at £26. So if you put that against the overall cap value, pounds per square foot, it demonstrates the reversion within the portfolio. The occupancy and voids, well, we're at 90% let at the moment. When we came to the market, we had a 30% void in our offices. It was there for a reason. We had 3 key developments. We like the void because that means we're in a refurbishment state so adding value to the buildings. So that's actually come down now, and actually within the offices it says 12.6, but that's closer to half year 4%, or post year end 4% after that 20,000 square foot letting. And the weighted unexpired lease term is 11 years to expiry and 10 to breaks. For a regional office player where you're doing leases at 10 breaks at 5 breaks at 3, we've got good quality of income.
This just shows how the rents stood when we were on AIM, when we went to AIM. We started at 5.9. We knew we were going to lose some income in Somerset House, Birmingham, because the principal tenant there was only on a 6 months remaining lease term, which is why we bought it, because we knew we were going to get vacant possession and we'd have a chance to add some value. We were able to replace that income by renegotiating terms with one of our tenants that I'll talk about in a minute at Milton Keynes, and that effectively replaced the income that we'd lost by getting the rent up on the Compass lease in Milton Keynes from 875,000 a year to 1.6. And we've been growing the income stream since then by the full letting of Somerset House, by the gradual letting at Kent's Hill Park in Milton Keynes, which I'll come on to, and by letting up at Great Charles Street, which is ongoing, which Ed will talk to you about, and other leasing events. This is rent reviews, lease renewals, the usual stuff that we do as property owners and managers that doesn't happen today or tomorrow or the next day, but it's happening typically over a 5-year period, a 5-year cycle.
So the first case study, Somerset House in Birmingham, it's just outside New Street Station in Birmingham by the new exit to the station, a couple of 100 yards from it. And what we did here, we bought a building with 3 or 4 months or so to Shakespeare's solicitors and all of the offices. And downstairs we had a vacant 2,000 square foot restaurant on the left-hand side. On the right-hand side we had a small nail bar. And we acquired this from M&G. It was a best bid scenario. We didn't come the top bidder, but we were known to be reliable and trustworthy, and they thought that we would be the better buyer for it, and we got the deal. We got planning permission on the whole of the ground floor to create 2 5,000 square foot restaurant units, so we pushed back into the old meeting rooms of the offices of the solicitors, and the northern one we let to Las Iguanas, the southern one to Cameron's Brewery at just under £400,000 per annum on 15 years term certain on the leases. Then upstairs, we took a delapse payment. That's when the tenant vacates a building and they've got their repairing obligations, and they give us money because they haven't repaired the building as it should have been. And we took a £450,000 payment from them, and we spent 4 million doing a refurbishment on that building. It was the one you saw at the front of the presentation where we exposed all of the services and the parquet floor in there. On completion, we had 2 tenants for it, BE Offices and the Office Group. And we let it to BE Offices as just under £800,000 per annum. So very high level maths for it. We bought it for 8 million, and we spent 4 million on it, and we had 50% gearing, so 6 million of our own cash. We've been offered just under 20 million for it, so that's £8 million profit on our 6 mil. The figures you're seeing here on the bottom, the profits of 6 mil, return on equity of 70, that's based on the valuation, but we know it's not the right time to sell it because it's reversionary, it's off £20.50p, and now the tenant's fitting out. It'll be a nice asset to sell maybe next year. My second case study is Great Charles Street, again in Birmingham city centre, just inside the Ring Road. This was acquired from a REIT, so it was 80% empty at the time. The REIT, the way they're structured and having to distribute their income, and we're a propco, we don't have to do that. They didn't have the money to do the refurbishment, so we refurbished it. We bought it for £100 per square foot. We spent £85 on it. We're doing lettings in there at £18.50 and £19.50, and we're about 60% of the way through the lettings of this building. It's located by Paradise, which is 1 million square foot's worth of hotels, restaurants, offices going in, rejuvenating Birmingham city centre. This is our biggest investment. It accounts for about 25% of our value, 22 acres of conference centre and business park in Milton Keynes.
The area in red is let to Compass, a FTSE 21 or thereabouts company. That wasn't always the case. When we bought this, they were on a management agreement on a turnover rent, 3 months' notice on either side, but we quickly drew to their attention that they were paying about 40p a foot, which didn't seem particularly attractive from our point of view as landlords. When we were refurbishing space in here, in the business park, and achieving rents of £15 a foot, we thought we could do better, and we told them so. So they became a tenant, initially on a 10-year lease. The rent, day one, went from 100,000 to 875,000, which was still a lot less than the going rate would have been on the offices. We've subsequently re-geared that lease again, and we now hold Compass on a 25-year lease at just under £1.6 million per annum, with annual increases between 1% and 5% RPI, capped at 5, collared at 1, which we regard as a grade A gilt play type investment, and the intention will be to sell that into a very receptive market, because frankly our job is done. We can add no further value, except in one corner. Up here we have the option to take back from Compass that building, which we'll call K3, K1, K2, and to be K3. That's a smaller building than the ones we've already done. We refurbished that and let it within 6 months. We refurbished its bigger brother, K2, 40,000 feet. And it took longer to let, and I think Brexit probably took its toll, but we've just announced recently the letting of the last piece of that property. The first floor of that building was let, as you've heard from Edward, £17.50 to a housing association on a 10-year lease, no breaks. So we're going to take this building back. It won't affect the Compass rent. The rent will stay the same. So effectively, we've got a free option on that building, and we'll be refurbishing it in the same way as we've done here and prove hopefully an even better rent to come.
Financial summary. We've now got a £100 million facility. It's a new one. Our last one was at 55 million. As of September, also as now, we're at 50 million drawn, or just slightly under. And it expires February 2023. So it was a 4-year term with extension for 2 years at a low margin, 205 over LIBOR. Our interest cover is 4 times at the moment. Our net loan to value was 40% excluding cash at bank. So it's about closer to 35% at the moment. But as we continue with our refurbishments, the value of the buildings go up and the loan to value drops down. The EPRA NAV and the NAV figures were stated 77 million and 2.75 as of the half year.
So the summary, Circle has consistently outperformed the benchmark and its wider peer group. We are, I'm told by people cleverer than I at working it out, that we are the top performing UK company listed sector as measured by total returns over the last 2 years. You've a seasoned management team at Circle with a proven strategy, and we're focused in what we're doing. We're delivering both income, currently around 3%, but total returns to investors 20% plus. Occupier demand, if it remains stable, will generate continued rental growth in the office sector as the trend for loss of offices to residential continues, albeit at a slower pace, because the differential and the benefit in changing, of course, reduces as office rents rise, but that trend is nevertheless still continuing. With ability to source attractive opportunistic deals, we've been in the business long enough, we know a good deal when we see it, and we are the first port of call for many agents who are keen to find a reliable buyer who isn't going to muck around, start chipping on price at the 11th hour, finding reasons not to do it, having wasted 3 months in the lead up. So we are a reliable buyer, and we are the first choice of many agents when they come to think about where they can put an interesting investment. So we've got an opportunity here to grow this portfolio and continue to generate significant returns, which takes us to the appendix, which I'm not going to go through except just to say the NAV bridge is the first slide. The NAV bridge just simply shows how the net asset value of Circle has moved on from 43.25 million when we came to the market to 77, but that is actually a little more than that now because we've added some further value since this was produced, and we've just announced that today, and it's another 20% return per annum. All of the properties that we own are photographed in all its glory, everything there, all good-looking investments, all in good locations, and I'm pleased to say letting very nicely where they're vacant. This was a former project of ours. We turned a very unloved building into a cracking investment, cost us £1 million, spent £1 million, worth 4.5. We've been buying in Bristol, with Birmingham. We're strong in Birmingham. We've got 3 buildings in Birmingham. The last 3, Baildon Bridge, Shipley, and Week Street, Maidstone, we've already sold. So that's the remnants of our retail portfolio, which is historic, which is now gone. And the only property that we own, which is not an office building, is that last one there, which is an industrial building, which we're not concerned about. It's a small investment, and there is an option in favour of the tenant to buy that in any event. I'll throw the room open, as they say, to questions, which we'll try and answer.
Hello there, just a simple one. Who owns your shares? Sort of institutional breakdown?
It's a mixture of private and institutional investors, family offices. We're just putting the story out there and are becoming more attractive to institutions. Many institutions, we would fall below the threshold at which they would invest. A lot of institutions only have a minimum size below which they won't invest. So we're not going to appeal to all institutional shareholders, but we'd like to think the clever ones.
Hello. There's a lot of talk in the London market of the end of initial 25-year terms. That's never going to happen again with 5-year, renewals and upward-only rents. Is that as true in the regional market?
In the regions, they're already doing lettings at 10s breaks at 5s, 5 breaks at 3s, and some of them are also competing with the serviced offices, which because of Brexit, people want flexibility, so they're not committing to a conventional lease, and they have got higher running cost expenses. So once you get to the other side and there's some form of stability, you could see people taking a 5 break at 3 in the regions. Generally in the regions, the leases are shorter, but it's also about the quality of the product. That said, we've done a 20,000 square foot letting with a 10-year break, with a 10-year lease and no breaks. So it's the quality of what we're providing. So we're doing best of quality grade B, would be grade A, but it's not new out the ground.
But I don't think it's likely that we're going to return to the days where 25-year leases or 20-year leases were the kind of norm and you wouldn't be able to let a building on a bigger letting. That they still exist on pre-lets. That type of longer lease will occur if you've got KPMG wanting to sign up on a swanky headquarters building in the centre of London or Birmingham or wherever, because the developer would need the security of that covenant and that long lease and all the terms attached to be able to finance the development and justify pushing it up out of the ground. But for our type of kit and for a lot of our competitors in the market, you take whatever. And I think because also the other point to make is because there's an increasing number of buildings being let to serviced offices, and the serviced office sector is having a heyday right now. All serviced office businesses are doing extremely well, I think, because they're feeding off a lot of uncertainty that is currently all around us with what's going on politically and economically. Nobody can read the tea leaves. And when you're in that sort of uncertain world, people don't like to sign up for long terms. Even bigger companies are reluctant to sign up for 5-10 years. They like the idea of moving into serviced offices, keeping their options open, quick in, quick out. So what we're having to do is to compete with the serviced offices to attract the smaller tenants by offering very flexible terms. And if we can't let for 5 years with a break at 3, we'll let for 3 years with a break at 2. Or if they don't want that, we'll let for 2 years with a break at 1 maybe. We won't give a rent-free period if we're only letting for a year or two, in the same way as a serviced office won't let a new incumbent in with a rent-free period, nor will we. So we'll fight them on the beaches.
2 questions. Firstly, where you have the tenant exercising the break, on a property particularly where you have refurbished that, so there's going to be no capital expenditure if in fact they exit, what's the notice period that you're seeking to get in these leases? Because you don't want somebody coming at the last moment, because filling that space, then you end up with a void, which is bringing your overall yield down. It
depends on the lease length. So if it was a longer lease when they came into it, so if you're doing a 10 break at 5, generally they're at least 6 months. So no less than 6 months, but no more than 12 months. So in other words, they can't take it day one and say, oh, I'm going to break in the 5th year, and I'll give you my notice today. So you have to run it. So by the 4th year of the lease, then they can give you notice. A minimum of 6 months. If it's one of the shorter leases we've got, or generally, and it's a 5 break at 3, it could go down to 3 months. But generally, really not less than that.
Yeah. And the lease will stipulate how notice is served.
Oh, yeah, well, which is obviously, yeah. And the second question, in reference to the rent uplift, open market value or the RPI, the higher of either or, what are you achieving? Is it in open market value where you're achieving the uplift, or are you relying on RPI?
Again, it depends which of our assets. If it's an office we've just refurbished, it's the open market rent. So that's how we're getting the uplift. We're creating something new. So a building we would have bought take Somerset House, the case study. We bought that off £20. It was of £17. We let it at £20. So we got the rental uplift in today's market. And we actually think it's going to be worth more. So because we spent the capex, that's capital expenditure, that's how we're increasing it. Or you've got the long lease in Compass John was talking about, that's got fixed uplifts built into the structure of its lease. So there are no rent reviews in that one.
And that was because on the Compass letting, it was offices and a residential conference centre, but there isn't that much rental evidence attributable to residential conference centres. So we felt it was better, particularly on a long lease, to have indexation in that lease, because that would appeal more to an institutional investor than it would have an open market. Occasionally you have either or, the higher of, as you were pointing out. There's no clear answer to what would be the best, because frankly you're crystal ball gazing as to what might be the best.
Yeah, I accept that it is a comparable evidence, okay, but if you're in other sectors, for example in retail,
yes,
then you'd be probably very happy to achieve an RPI, because you certainly wouldn't be relying on the higher in terms of the market rent.
Indeed. And even if you have a retail with an RPI increase, there's always the danger of CVA or something scuppering you. So that's a concern in the retail sector.
It was one of the earliest slides where you saw the rents increasing in the regions due to the lack of the supply of the offices, because it went over to residential. So that's what moved it forward. So you're generally capturing the new rent 5 years away, or it depends how long the leases are when they're coming up. So when we come to a lease expiry or rent review, we want that to happen, because if the tenant was to vacate, we can let at a higher rent.
Plus, we're not always achieving the highest rents, because generally we've bought the buildings wisely and we've spent wisely on improving them. We can afford to undercut the market. So if we're letting day one just to get bums on seats, we're not like a developer using a fund to fund the development, and we're on a profit erosion scheme, and we're only going to get paid out by the fund if we let at a record rent. We're not in that boat. All we're trying to do is create an income stream, get the building let at broadly the right rent as quickly as possible to minimise the void, because obviously whilst the building is empty, you've got empty rates, service charge, all these irrecoverable costs, and that has a drain on the income. So we like to get the buildings let as quickly as possible, and then if we're, because you've already heard, we're under rented typically, we know that even if it's an inflationary increase, we'll get it, but also on an open market rent, we should score as well to get the right rent in But it just means we've got to wait for the tide to go up.
Going back to the service offices, what's your exposure to them? Obviously, because they need certain, what sort of due diligence you do on them, because they need such scale to get any money. We've seen that the banks are currently turning away from WeWork, which are the biggest. And then the other question was the sort of the supply of offices that have declined massively. How much of that was due to oversupply from the previous peak and the move to resi, and then on from that, then how much sort of rental uplift you need in the likes of Birmingham until new development comes back into the market or makes it viable for new development to come back into the market. So basically how much of a buffer you've got to keep increasing rent before you probably hit that ceiling and supply increases again.
In reverse order, I think the serviced office market has come good because of the uncertainties we've said. The rents, we're not exposed greatly to the service sector. We have one building which we have let to a serviced operator, and we very carefully vetted who we would let it to. In fact, we had a choice of who we could let it to. There was more than one. We had an orderly queue forming, I'm pleased to say. We chose one that we looked at the accounts. We chose one that owned a number of freeholds themselves. And I think that's a very good test of not only looking at the profit and loss account, but the balance sheet. And if there's a substantial number of assets in there that they can fall back on if times get a bit thin, you've got some potential scope for continuity of income. So yeah, we're not exposed to the serviced office sector. We do generally compete with them, as you've heard a little earlier. Thank you.